The following information described within this video or blog post contains information pertaining to hypothetical trades. These trades were not executed and are for educational or illustrative purposes only. Please read the CFTC Rule 4.41 that's on your screen, and keep in mind, by continuing to use this site, establishing any contact with its author, and/or clicking on any of the links, you acknowledge having read and understand all the disclaimers and risk disclosures contained within my blog site. Hello, my name is Mike Sinibaldi, and welcome to today's video edition of the Chart of the Day. Today I'm going to take a look at a recent call that illustrates the benefits of using Elliott Wave in managing your trades. At the 120-minute chart level, I've been working a fourth wave flat correction and observing the developments of the wave structure as it approached my targets of 1191 and 1192. As I get closer to my targets, I like to drop my time frame so I can get a microscopic view of the final subdivisions of the pattern. At the 1800 tick level, I quickly noticed that divergence between price and momentum strongly suggested that a top was near. As prices rose, momentum waned. Looking at the wave count as I've labeled it here, the count looks mature with 5 waves complete. Yet, as you will see later on in this video, this count is actually not complete, but more on that later. My trade plan for this hypothetical trade that was made in real time using a simulated account is as follows. I'll make a short entry at 1185 with an initial stop just below the top at 1186.50 with an initial target of 1166.25. Shown here is my short entry at 1185 at 9:34 a.m. At this point, we don't know if I've labeled the top correctly, but what we do know is I'm looking for at least a minimum of 3 waves down if I'm wrong. So I've labeled the structure accordingly, either wave 1 or A, 2 or B, and 3 or C. The trade obviously progressed nicely and had me looking for a wave 4 up. I mentioned in real time on Twitter that the trade would remain viable as long as wave 4 didn't overlap the territory of wave 1, which is denoted by the red dashed line. So while I'm looking for possible further downside, prudent trade management would call for the stop to be moved just above wave 1 or 78.50. In real time, the market did break that level and printed 78.25 before heading lower. Was it luck that the stop wasn't hit? More times than not, it gets hit, but it still would have been a great trade. Moving forward, with at least 4 sections complete and wave overlap, traders should be on guard that the move from 86.25 was most likely not impulsive. But counting the subdivisions from 78.25, I could make this case that we have 5 waves complete and done here. Also, price had reached a point that was 2 points away from my original target of 1166.25 and printed within the span of the previous fourth wave, a logical support area for the market. Therefore, I exited the market at 1171.25. By using the wave principle, traders were tipped off early on that the structure from 1186.25 to 1167.5 was a corrective wave structure. And subsequently, if you had not have known that, the market retraced a significant portion of the original 3-wave structure, was unable to make a new low, and took out the previous highs, which have violated another Elliott wave, where even if you misinterpreted the wave structure as a wave 1 low here, it would have been nullified when your wave 2 point would have exceeded the origin of wave 1 at 1186. To summarize this hypothetical trade, the short entry was made at 1185, and I exited the market at 1171.25. In conclusion, the Elliott Wave Principle helps you stay on the right side of the market and quickly identifies where you are right and where you are wrong and how to manage the trade. I hope you found this video helpful, and best of trading.